CEOs consider the initial public offering option primarily as an alternative source of capital. Pre-IPO, the manager can only raise funds through incurring debt. They have a limited number of potential investors, also meaning they have a limited amount of money available to them. Post-IPO, the manager is able to both tap into more investors as well as a larger pool of investment capital. As INC magazine states, quote, "For a company going public, the infusion of capital offers management an opportunity to accelerate its growth by hiring more people, conducting more research, and delivering more products and services." End quote. Furthermore, this new capital does not have to be repaid, as investors get paid through dividends and stock value appreciation. Finally, utilizing less debt equity improves the company's debt-to-equity ratio, increasing its potential worth to investors. Therefore, the company has more potential investors and a larger pool of available funds, all of which come at a cheaper price because the capital does not have to be repaid, and the company becomes more attractive as its debt-to-equity ratio decreases and its stock value increases. Liquidity is important for flexibility in decision-making, and offering an IPO is an excellent method of increasing liquidity. In addition to the resulting lower debt-to-equity ratio discussed earlier, increased liquidity from an IPO increases company worth and allows managers more money to invest in projects and other such value-adding activities. Since liquidity is a large factor in loan risk evaluation, going public also secures the business more favorable loan terms. As the J.H. Chapman Group says, quote, "Because a public offering increases the company's net worth, a company that has gone public should find it possible to borrow funds in the future on more favorable terms." End quote. Therefore, an IPO increases both the company's worth and its liquidity, which secures a better price for funds as well as decreases the risk for current business owners. Offering an IPO is also beneficial because it determines the company's worth, which is important for acquisitions and selling, and attracts high-quality management as well. Knowing the company's worth is necessary for acquisitions as well as selling. As the Chapman Group states, quote, "Going public is also a vehicle for establishing a value for the company's equity. This puts the company in a better position to acquire another company, or for that matter to be acquired." End quote. Knowing the value of the stocks is vital for attracting, retaining, and motivating certain individuals. A company can better recruit top potential management with the option to own shares in the company. Managers owning these shares further benefit the company because they have more incentive to increase the value of the company, therefore increasing the value of their own shares. This means the company attracts higher quality personnel while simultaneously maximizing the work quality of those higher quality personnel, driving the company's worth even higher. Finally, the IPO drastically reduces the risk for the entrepreneur. Going public relieves the owner of the sole financial responsibility of the firm. Instead, the previous owner retains a certain amount of stock in the company, representing their claim to capital gains. The only risk the owner is left with is the possibility for those stocks to lose value, rather than full financial responsibility for all claims against the company, as was the case before. Diversifying the business risk among more shareholders allows management to take more calculated risks than the owners would have been comfortable with, representing the possibility for large capital gains and the resulting appreciation of stock. Therefore, the owner ultimately carries less risk, which allows the company more opportunities for large rewards. The key to a successful IPO lies in timing. Both the company's position and the market must be right to maximize the possibility of a successful IPO. As the Chapman Group states, quote, "Initially, the most important ingredient is timing. Looking within, you must assess the amount of management time that can be devoted to taking the company public. Also, an assessment needs to be made by an expert as to whether the concept has the ability to sustain an increasing rate of earnings that will satisfy investors. It is true that an IPO is quite time-consuming. Management must be prepared to focus sometimes exclusively on the IPO, which can take from 6 months to 2 years to complete. This can be draining on operations, but through careful planning it is not insurmountable." As the article continues, quote, "One must also evaluate whether the company is in the most opportune stage of development to maximize the objectives of the public offering." End quote. Therefore, an honest review of the company's current position, including goals, must be completed before jumping into an IPO. The timing of the market is equally important. As the Business Encyclopedia states when referencing the book The Entrepreneur's Guide to Capital, quote, "Lindsay suggested going public when the stock markets are receptive to new offerings. The industry is growing rapidly, and the company needs access to more capital and public recognition to support its strategies for expansion and growth." End quote. When both the company itself as well as the market at large are ready, an IPO becomes a vitally important business strategy that will raise huge amounts of capital and enable the company to thrive.